Hello everyone, how are you all doing? Hope you all are doing great. So this is September December 2020 question 2. All of you have been asking me when is it coming, so here I am with question 2, and question 1 also will be coming soon. Question 3 is already uploaded. Please go and check under AFM past paper solution. So coming to question 2, let's read the requirements first. Part A. Evaluate the suitability of the investment proposal in Canavia, including the impact of the country risk premium on the net present value of the project. So this is they're talking about the suitability. Whenever they say something of suitability, feasibility, or acceptability of investment proposal, indirectly they're telling you to calculate the net present value. Okay, whether it is positive or negative. But in this case, you have to write including the impact of the country risk premium. It's very important. Okay. So, coming to part B. Explain the possible strategies Colvin Company could adopt to avoid a block on dividend remittances if Canva's opposition party was to win the election. Okay, so here you have to talk about, this is a theory part, and for this you need to have knowledge of what are the ways to avoid a block on dividend remittances. This is from your textbook. What are the possible strategies? 4 marks. Coming to part C. Discuss the validity of the chief executive's reasons for adjusting the discount rate used in appraising the project in Canva. Okay, adjusting the discount rate. What could be the reasons of the chief executive's reasons? So whenever this type of question is here, discuss the validity of some person. In this case, this is the chief executive. Mostly it is the people in the head only, the senior people, chief executive officer or chief financial officer, like that. You have to validate their point. In that case, you have to refer the case study. From the case study, you have to tell. You cannot give general points. Unlike in part B is a standalone theory question. This you can give from your knowledge from your theory part. So there's a difference. Some theory part is from your, simply you have to depend on your case study. You have to use facts from there, and some you have to go from your theory, whatever you have studied from your textbook knowledge, and some you have to write both from your knowledge, and you have to use a case study as well. But part A is calculation. Okay, so, and it's a 25 marks question. As you can see, we have done a lot of questions of net present value in what section A as a 50-mark question, but here we are discussing it as a 25-mark question. So I want you to note what are the key differences. The key differences is no professional marks, no report writing, and also it's just very few marks. Okay, so but that does not mean that you don't have to do the main steps. Okay, so now let's read. Coming to Colvin Company. Colvin is based in Eurozone region and was established 10 years ago to manufacture competition standard bicycles for professional road racers. Where the company obtained a listing 5 years ago, the founder retained a small minority shareholding. Remaining shares are held by a number of institutional investors. I'm sure you know who institutional investors are. From your SBL study, you must be familiar with it. Coming to second, the board recently decided to expand the range of models and to look for new growth opportunities abroad. Whilst manufacturing is currently restricted to the Eurozone, the board of directors have identified Canavia as a key growth market and is considering a potential investment project to manufacture and sell a new model there. This would involve establishing a subsidiary in Canavia. Project information. So if you see the first for Colvin Company, not much information. Okay, you don't have to use any information for your calculation part from there. Coming to project information. And one more thing which I want to tell you, when you're reading case study, don't just jump to the points where numbers are there and start. Let's say this is net present value and most of units starts with sales. So what do? You go under your project information and you see where the sales are, and you start writing sales. Avoid that technique. This should not be your technique, guys. You have to start from the beginning of the case study, because in the beginning there are some key information out there which is very important. Even when you do calculation, it will help you. Even though you are not using any of this sentences, first 2 paragraphs for your calculation part A, you still need to read it. It's a background. It is giving a background to the case study. where the company is based. From there you will know the currency, what the country is into, company is into. So all these things will help you. You have to read it first. Okay, so make it a habit that you start from the beginning and don't jump in between. So coming to the project information, the currency in Canva is the Canvian lira and the current exchange rate is this. So this is the current exchange rate. You are based in Eurozone. It's very important that you know where you are based in, underline it. Why? Now what happens when you go and read there? From the sales you start picking number. You don't know what is your home country and what is the foreign currency. And this is a currency question. It's an international net present value. So you have to do a net present value also, exchange rate also. Let's go down and see if you can see here. They have given you the currency, right? Exchange rate is given. That means you have to use exchange rate. You have to convert. So you have to know which currency the home, what is your home currency, what is your foreign currency. That will always be given in the first paragraph only. First line only they will tell you where the company is based, in which country. Okay, so these are some keywords. Please follow this little techniques and it will make wonders. Coming to the annual rate of inflation. Annual rate of inflation will be given to you. Okay, is expected to be remain at 10% throughout the 4-year duration of the project. So inflation is 10% for 4 years. All the 4 years is 10%. Okay, so coming to the finance director's estimates, project sales volume inflation adjusted. Okay, pre-tax contribution fixed cost as follows. So volume unit has been given pre-tax contribution. That means you have to adjust for tax. This what pre-tax tells you, that you have to adjust for tax. Everything whatever is pre-tax have to be adjusted for tax. Never leave it in a pre-tax form. Okay, it have to be post-tax. Coming to a fixed cost. Now just because cost is fixed, it is a fixed cost, just okay, do not assume that you don't have to inflate it. If inflation is there separately for fixed cost, you have to. Okay, and see the currency also. Very important that you see in what currency it is in, because sometimes your sales might be different currency, your cost might be in different currency. You might have to keep some currency as it is if it's in your home currency, and foreign currency you have to convert. So be very careful when it's an international net present value. What is the currency? Okay. So the project will require an immediate investment of CL 75 million in land and buildings and 700 CL in plant and machinery. So, okay, tax allowable depreciation. Tax allowable, I have told you always. Tax allowable depreciation, 100% it will come for your exam. 100%, there is no doubt about it. So learn it and go. You should not be going there thinking that I was assuming that it will not come. It's not an option. It's compulsory. It's a must that you should know tax allowable depreciation. So tax allowable depreciation. You can even write TAD, short form, because these are some short forms which are not commonly used. Okay, it is only for AFM you can use TAD, tax allowable depreciation. On plant and machinery, make sure tax allowable depreciation is only on plant and machinery, not on land and buildings. So don't take the full cost and put tax allowable depreciation. Make sure it is on what, and also make sure what is the basis, reducing or straight line. So it is a straight line basis at an annual rate of 25% at cost. Okay, so Colvin's finance director. Okay, one thing I want to tell about tax allowable depreciation, since it is 25 and this is a 4-year project, so there will be no balancing allowance or no balancing charge at the end. Why is it? Because 25% for 4 year, 25, 25, 25, 25, 100%. Okay, so at the end your plant and machinery, the value will be 0. Okay, you are not left with anything. So tax allowable depreciation at the end, 4th year, sometimes you see there's a balancing allowance or charge. So that balancing and allowance charge only comes when you're selling the plant and machinery at the end of the 4th year. Okay, or the percentage, let's say in this case they are saying it is on a straight line basis and the percentage is, let's say, 20%. So 20, 20, 20, 20. What about the rest remaining 20%? It should be total 100%, right? So that remaining is your balancing allowance. at the end of last year, fourth year. Okay, but in this case there is no such issue. It is simple because it is just 25%, and this is 25 mark question, so they will keep it simple. So on cost, Colvin's finance director believes that the plant and machinery will have a zero residual value at the end of the fourth year. Okay, so the land and buildings will be disposed at the end of the project, and their tax exempt value is exempted to increase at an annual rate of 30% throughout the 4-year life of the investment. Please read this line again. It's not easy to understand. Land and buildings will be disposed at the end of the project. Land and buildings will be disposed at the end of the project. That means fourth year. So what happens because of that sales? Of course, you are going to have a disposed value you are going to get, right? Sales on that, and their tax exempt value is expected to increase at an annual rate of 30% throughout the 4 year. Throughout the 4-year life of the investment. Okay, this I will explain you when we do the calculation. Through calculation we'll explain, because if I tell you otherwise you will not understand. So the project will also require an immediate investment in working capital. This is another thing. This investment in working capital will come. Investment, the initial investment and working capital, and then recovering that working capital. This will definitely come. This is also a question, area 100% it will come. Okay, working capital. And all are in same currency, so that's one good thing. The annual working capital requirement is expected to increase in line with inflation in Canada. Make sure at how are you calculating working capital for each, it matters a lot. Okay, this working capital as 25 will be in year 0 as an investment. Then what about year 1, 2, 3, 4? How are you going to get it? Okay, so annual working capital requirement is expected to increase in line with inflation. Sometimes it's on sales, increase on sales. This is increase in inflation in Canada, and it will be released back in full at the end of project. It's always released back. Okay, that's an assumption. So Colvin has a policy of extracting. Make sure sometimes in some countries they have some policies of remittances and all. Please make sure that you underline that policy is very important. And even in this question also we have in some requirement, I think B or C, our dividend remittances. Okay, so Colvin has a policy of extracting remittable cash flows as dividends at the earliest possible opportunity. Okay, all components for the new bicycle will be produced or purchased in Canada, except for a gearing system component which will be manufactured by Colvin in the Eurozone. So if you see, except for the gearing system will be manufactured where? In this one, in Eurozone. So this currency is different. Rest all will be purchased and produced in Canada. So the cost of acquiring this component from the Eurozone is already included in the pre-tax contribution estimates. Already included in the pre-tax contribution estimates. Okay, from the euro. Okay, based on a transfer price of $10 per component. Yes, this transfer price. Okay, this transfer price is also an area which you need to be you need to know how to do it. Okay, it's not easy, it's not difficult. The way it looks like, it's very easy. Okay, so based on a transfer price of euro 10 per component, the finance director estimates a manufacturing cost of euro 2 per component. Okay, both the transfer price and manufacturing cost are expected to increase in line with Eurozone annual inflation rate of 4% in the first 2 years of the project and 2 years in year 3 and 4. So this transfer price and manufacturing cost will also increase with Eurozone's annual inflation rate of 4% in first 2 years and then 2% in year 3 and 4. So first and second 4%, 3 and 4 2%. Corporation tax in Canada is payable annually at a 25%, and companies are allowed to carry losses forward in the offset against future trading profits. So tax in Canada is 25%, and they can carry loss forward to be offset against future trading profits. Colvin pays corporation tax in his home country. Okay, so Colvin pays tax at what? at 20%. In his home country at an annual rate of 20%. If you see there are tax rates are different, that means let's see whether we have double tax treaty or not. Okay, always it is, there will be a double tax treaty. It is always there. So you don't have to worry about it. Whatever tax you have paid will be offset if you have paid more tax than your home country abroad. So you don't have to pay the tax in your home country. Taxes are payable in both countries in the year the liability is incurred. Okay. A bilateral tax treaty exists between the two countries which permits the offsets of overseas tax against any domestic tax liability incurred on overseas earnings. So if you have paid tax overseas, you don't have to pay in the home country. If the tax rate is more, if it is less than the remaining, the balance you have to pay. That is the meaning of bilateral tax treaty. This is always there. Discount rate, this part. So the board proposes financing the project with a mix of equity and debt in such a way that the existing capital structure remains unchanged. For the purpose of this project, the chief executive believes that Colvin's WACC 30%. So Colvin's WACC is 30% and should be adjusted to include a country's risk premium on the basis that Canada is developing economy that appears to be economically less stable than the Eurozone countries. So what does it mean? Why the WACC has to be adjusted? See, WACC measures the risk. Higher your risk is, higher will be your WACC. Okay. It measures the risk at cost of capital. The lower it is, the better it is. So they are saying this 13% have to be increased further. They have to be adjusted. Why? Because that country risk premium. There's a risk for the country also, right? They are economically less stable. They are a developing economy compared to Eurozone. That's why this 13% they feel has to be higher than 13%, the WACC. Okay, why? What are the bases? Canada is a developing economy, economically less stable than Eurozone. She made this decision after consulting a country risk index, which compares the standard deviation of the market returns in various countries. Okay, so additional factors taken into consideration include foreign exchange risk, the fact that there have been frequent changes of government in Canada, so there have been a frequent change in government, and the main opposition party has threatened to reintroduce controls on our dividend remittances. So what did opposition party did? To reintroduce controls on dividend remittances. What we saw before, that they have this policy of remitting as early as possible wherever they get the opportunity. But now if the new government comes, opposition party comes, then it will be a problem for the company. They cannot impose that policy because they are going to put control on the dividend remittances if elected. You have therefore been asked to use a discount rate of what? 16% to appraise this investment project. So now when you do the net present value, not 13%, you have to use 16% as your WACC. Now do you understand? Okay. So now coming to part A, we have to find net present value. So let's directly go to the answer. And let's see. Project cash flow. How do you start this? Start like this. Okay. Start first, you have to start writing year, then write the number in this format, in the vertical format. Then project cash flows. All figures are in CL millions. Please write it. Whatever currency you are taking, it has to be CL million, of course. Right? Later you have to convert into euro because CL is the foreign currency. You have to write it in this currency. Do not first write everything in euro, because euro is a home country. Why? Because if you do that, you have to change every now and then, you have to keep changing the exchange rate. By the exchange rate, you have to change the figure, you have to change, because everything is in CL. So it is better to work everything in CL, and at the end, the final net present value, you can use exchange rate and convert to euro. That's more, it saves more time and it's faster also, rather than changing each and every figure to euro. Okay, so starting with then you have to use that. Okay, so now starting with contribution. Okay, you start with sales, but sales minus cost is contribution only, so you start with contribution. Okay, if you see here, Contribution, there is no working. Wherever working is there, you have to show working in bracket in front of that. Wherever there's no working, directly you can take. Okay, you can just write it. Okay, so now starting with contribution, if you see here, the pre-tax contribution. Okay, they have given you the sales volume also, and we'll understand. Then you are thinking why they have given us the sales volume in units. If already they have given us the contribution, then why do we need the sale and the cost? You will understand it later. Okay, of course there is always a reason behind something if they give you some figure. Okay, they never give something which is not for you to be used. So you have to use everything. Okay, you have to think a paper like that. Whenever this figure is there, think that why they give this figure. You need it somewhere, that's why it is there. And when you see that this is starting with contribution, you are in a habit of always starting with sales, then deducting all costs. It is same only. Sales minus variable cost is your contribution only. But in this case, you cannot start with sales. Why? You are only given the volume. You are not given the sales price. Because volume into price is only sales. Then how will you start with sales? You always have to think like this. When you are not getting a figure, tell to yourself why you are not able to start. Because you are not given the sales price. How will you start? So what is the next step? How can you start? Think like this. Always don't get stuck in one thing only. Okay, we are always starting with sales. Why am I not able to start it? If you have this mentality, you will get stuck. You will somehow try to write that sales. Some of you might even write the sales volume itself there. Okay, you just try to fix somewhere. So don't try to fix it. Okay, there is another way. What is another way? Is starting with contribution. You are given contribution. So why not start with contribution? You can. You can. Okay, and it is pre-tax. So start with contribution as it is. You can write 419.4 500. So this wherever, and have this habit of marking, ticking. Okay, let's say when you have written sum and posted in your table, tick it in your question paper, because that will make you realize when you go through your question paper. Of course, you'll be going through your case study several times, not just once, right? To pick many numbers, to take your fixed costs and remaining extra etc. That time this shall help you. When once you are ticked, you know that you have used it, you have wrote it in the main table. So now I know that pre-tax contribution I've taken 419.4 500.2 671.3 Let's see from the table here. Yes, so contribution is done. Put a tick. You don't have to put tick in your paper, okay, when you're writing the answer. I am putting a tick for you to explain that we are done with contribution. Coming to fixed cost. Next is, what is next? Fixed cost. It has to be deducted. So fixed cost, if you see, okay, fixed cost also you can take as it is. The reason why you don't have to inflate it is why? Inflation adjusted. Already it is adjusted for inflation. That is the reason why you don't have to inflate it. So don't try to go and inflate it again. This is a very common mistake, that once they are told that it is inflated, adjusted, again you go and adjust with inflation. Then it's an effect of double inflation. So please avoid this. Read it. Sales volume. Okay. Rest all, they are already inflation adjusted. You don't have to inflate it again. But yes, rest all, whatever is down, you have to inflate it. So it has to be deduction, right? So I will mark here first. Fixed cost is also out. Next, after fixed cost is tax allowable depreciation only, because we don't have any other cost here. Okay, so tax allowable depreciation, if you see, it is 175. It is straight line basis, 25 basis on the cost of what? What is the cost of plant and machinery? It is 700. So take 25% of 700. It is 175 for all the 4 years. So no working is required for tax allowable depreciation also. Okay, let me write it in bracket. If you want, you can write in bracket 25% of 700. Okay, if you want, you have a habit of writing it, you can do it like this also. Okay, straight line basis. So 175. Then coming to your taxable profit or loss. Okay, after you deduct. So taxable profit or loss, if you see, first year you are having a And don't start with year 0. Okay, keep this blank. In year 0 you are only writing your working capital and your investment, initial investment. Only this two goes in year 0. Rest all falls from year 1 to 4. So taxable profit, if you see first year it is taxable loss, and you have a policy to carry forward the losses and adjust it with the taxable profit, taxable trading profit. So if you see 25.6, so here you're nothing to adjust. That means no tax. Okay, and you have to add back your depreciation here. If you see this, why you have to adjust? Because you don't have that assumption. Usually they state this assumption that tax allowable depreciation is equal as the investment, reinvestment in non-current assets or something like this, right? This assumption is there. At that time you don't have to add it back, but in this case nothing is written about anything, only the rate of tax allowable depreciation. In this case you have to add back your depreciation. Okay, so you just add it back. Once you add, that's so minus 25.6 plus 175, it's 149.4. And then your working capital, but for that we'll do it later. Now coming to your tax. Second year when you go here, this one, this 25.6 you bring it here and adjust it with your profit, because you have a profit in year 2. 8. So on that 8 you are taking 25% because tax is 25%, right? Let's again go and check the tax rate, because there are two tax. Yes, Canvia it is 25, correct. So you Canvia's tax rate you have to take. So now on 8 you are taking 25%, which is 2. So like for the other third and fourth year there's no issue, you can just take 25% on the adjusted taxable profit, and then the losses carry forward. You have to add the loss carried forward. Where is the loss carried forward? This, if you see here, this 25.6 needs to be added here. Even the loss carried forward, it is not a cash item, non-cash item. It needs to be added back. Whatever is non-cash item, because you're from profit, from taxable profit. Why you're adding it back? Please understand. Your purpose is from taxable profit, you're moving towards cash. You need cash flow, not profit. So to convert this into cash, you have to add back your depreciation, all non-cash item. So losses carried forward is also a non-cash item. So you have to add back. Okay, 25.6. This is something new, because losses carried forward is not a question which frequently comes. Very recently it started coming. It was not there before in the very old past paper. But depreciation and all we have. Then we got our cash flows after tax. Okay, so once we got our cash flows after tax, what is this? Working capital and investment cost. Investment cost is what? Investment cost, the initial investment, is simply 700 plus your land and building. What is the value of your land and building? 25. So it is 720. Sorry, not 25. 25 is working capital. 700 plus 75. 775. Only in year 0. Okay. But you sold land and buildings. Okay. So we have to adjust for that. But that we'll do later. First, let's finish with working capital. Okay. Working capital year 0, it is 25. Okay. But when you calculate for the next, if you see here, working is here, working 2. Okay, you need working. So let's go to working 2 directly. Okay, you have to keep some space for all this. These are main workings. Okay, then you have to go, and if you see working 1 is your exchange rate. Working 1, keep it as exchange rate. Whenever you have this exchange rate issues where you have to find exchange rate, convert it. First working keep as your exchange rate. Then next working is whatever it is there. So here it is exchange rate using the inflation of the two country. So years, because the exchange rate what you are given is current year 0, you need to find for 1, 2, 3 and 4. Okay, if you see here, it is 9.91 into 1.1 divided by 1.04. Okay, so we'll go and check the exchange rate. Here it is 9.91 if you see here. But what is the inflation? Okay, and it is CL. So then your numerator have to be the inflation of CL divided by inflation of Canvia. Sorry, inflation of Colvin. So what is the inflation of? Inflation is 10%, I remember. Yes, Canvia it is 10%. So that's why it is 9.91 into 10, because this is the currency is CL. So even the inflation has to be of CL. So that's why it is 1.0 divide by of Colvin, the home country. What is the inflation? What is the inflation of the home country? It is 4%. But first 2 years. So it is 1.04. Now do you understand why it is like this? If you see here it is 4%, but here it will be 2%. But this remains same, 10, 10, 10, 10, 10. Okay, and then each year bring this forward, bring this forward, bring this. This is known as purchasing power parity. Whenever inflation rates of two countries given to you and the current exchange rate, the spot rate, the exchanges which you are calculating, the formula is known as purchasing power parity. Let me write it P. So you should know when to use it. Most of you know the formula for PP, which is given in your formula sheet also, the formula front page. But you should know also how to use and when to use it at the correct time. Knowing formula and memorizing it and keeping it in the back of your mind does not serve any purpose if you don't know how to use it and when to use it at the correct time. Okay. So now you are done with inflation exchange rate. Coming to working capital number 2. Labeling your working and writing it is also very important. Presentation is a must. It is not optional that you want to make it clear and neat. Keep it. My answer is right. So you should not be too arrogant and neglect and you have to neglect. No, you should not neglect your presentation. The way you present, even your appendix, even your workings matters a lot, because you're getting marks ultimately for those workings only. Because if your workings is correct, there is no way that your main answer could go wrong, unless if you put it in a calculator, and there it might be wrong, but still at least you have marks. This is your evidence, this is your proof. You're backing it up with workings. So working to number it 1 2 3 4 like that, and working capital name it also. Working to is what, not just working to and start doing calculations. And also working capital in which currency. Here also starting with 0. So 0 1, you have to start with 0, even though it's a 4-year project. So inflation, you have to adjust for inflation. Inflation in CL is what, 10%. So first write the inflation from year 1 2 3 4, not from year 0. 0 there will be no inflation, remember that. Okay, because inflation changes annually. So increase with inflation. What is the working capital initially? It is 25. It will be in bracket. Put it in bracket, please. Initial investment working capital have to be in bracket. Okay. So whatever is your incremental working capital is only, that is your increase with inflation, 25 only. Next, when you go, they told that it will increase with inflation. Okay. So that means 10% of 10% of 25. So 10% on 25 is 2.5. So 25 plus 2.5 is what? 27.5 or 1.1. Okay, 1.1 into 25, 27.5. So that's why we got 27.5 here. But okay, this is a little confusing. You might get a little confused. But if you do over and over again, you should be familiar with it. This is 27.5, but in year 1, you cannot write 27.5. You have to write the difference in year 0, in year 1. So year 0 it is 25, year 1 it is 27.5. Okay, basically what is this increase from here to here? That jump only you have to write from 25 to 27.5. How much it increased? So that increase, that incremental working capital only you have to write. Understood? That's why it is 2.5. So this 2.5 only will go in your main table. Let us go and see. If you see here, 2.5, only the increase amount, 2.8, 3. Here it's a different case. We'll go to year 4 later. Coming to year 2. So year 2 also 10% of 27.5, which will be 30.3. So but we already have 27.5. So how much it increased From 27.5 to 30.3, 2.8. From here to here, this increase is 2.8. Next, from here to here, increase 3. Okay. But when you're coming to the fourth year, what is it? There are two ways of doing this when you're going to the fourth year, because they told in the fourth year it will be recovered. One way, easy way, is to write this as it is. Whatever remains in the year 3, that balance 33.3, you write it. Another way of doing it is, okay, since this is 25, right? Okay, so just add all from year 0 to 3, that total amount only, because see, whatever is your payment only you will be receiving, right? So 0, 1, 2, 3, you have to add working capital 25, 2.5, 2.8, 3. So just add and tell what is the final answer. It is 33.3. It's a payment, right? So you will be receiving what? Recovering 33 only. Whatever you paid only you will recover. Okay, at the end it has to be 0. So that's why it is 33.3. These are the two ways. So 33.3 only will be recovering here. If you see your table, where is it? This one, 33.3. Understood? Now coming to investment. So 77.5 we know, but what about the fourth year? If you see 214.2, how did we get it? Okay, if you see here, there is no working for it. Okay, some additional working we have, but that is when you convert it into euro, then we have. But from CL's point of view, this investment cost is only remaining 214.2. How did we get it? Let us read that thing again, because by now you forgot also what is it, right? Land and building disposed at the end of project are, and that as well as expected to increase at annual rate of 30%. What is the amount? 214.2. Okay, and the value is 775. And they told that land and buildings will be disposed at the end of the project. The tax exempt value is expected to increase at an annual rate of 30% throughout the 4-year life of the investment. What does it mean? Because since there is no working for this, okay, we'll see whether there's any working or not for the investment cost. No, there is no working for it. Then how did you get 214.2? Now we have to think a bit. So think. Okay, it is relating to your land and buildings only. 75. So basically in year 0, if you see, land and building is 75. Okay, 75. So 1, 2, every year you have to increase it by 30%. 3, 4. Okay, so 1.3 into 75 on this, 1.3 on this, 1.3. Fourth year, whatever the value you have, that value it is 214. Okay, if you want, take your calculator, try 75 into 1.3 into 1.3 into 1.3 into 1.3 for the fourth year, or you can just write 75 into 1.3 to the power 4. Okay, because for the 4 year it will keep increasing. You will get the same answer. I will write it here for you. 75 into 1.3 to the power 4. It is 214.2. This is the value. For year 4, that is the value you have. That's why you are getting 214.2. Okay. Then with the cash flows. And then all figures are in. Now you have to write the figures in what euro. In your home country, you are converting it. So now that exchange rate, what you did in working 1, just put it and convert it. That's it. Okay. You have even written also work 1. So now total investment cost. So what are you converting? If you see here for year 0, it is the total investment cost. Okay, I'm keeping both together for you to see the cash flows. Okay, so cash flow was 800, the initial investment in year 0. Now you convert it into euro. You just divide 800 by 9.91, you will get 80.7. Something you will get, round up to one decimal place. Okay, so for the first one, it is 800 divided by 9.9. Likewise, you have to divide all the cash flow. Okay, for year 0. Coming to 1 to 4, it is the remittable cash flows. 1 to 4. Because of course initial cost you will not remit. Cash inflows only you will remit. So first one is 146.9. Divide by 10.48. So you are getting 14 point something. So likewise you have to this you have to divide it. This you have to divide by what? 10.48, 11.09, 11.96 and 12.89. Okay, divide. When you are dividing, you don't have to show that you are dividing. You can just put your calculator and write divide, because you already wrote the exchange rate, so it is understood that you have converted. So now remittable cash flows. Next, component contribution is there. This component contribution you have to work when you convert it into euro, because from euro's point of view is the contribution. That's why we didn't take this component. So don't get this component contribution with this. Don't get confused. This contribution is for CL, what they have given. The other component contribution is from euro. That's why after we convert to euro only we are taking that component contribution. We didn't put it there because it has nothing to do with CL. And for this we have a separate working 3. Okay, and when you have working, keep space 1 or 2 page depending on your estimate, your judgment. And then we are going to working 3, component in euro. Component contribution. Now do you understand why they have given that sales volume to you? For finding this component contribution only. It is not for finding that CL thing. For CL already contribution they have given. They want for euro. So now contribution, how do you calculate contribution? You have the units and you have the contribution per unit, whatever it is. So the unit, the sales volume only you have to take from here. 109, 121, 148. This will go now. The sales volume units. And what is the contribution per unit if you see here? Here they have told the transfer price is 10 and the manufacturing cost is 2. So from the transfer price, that is the sales and cost. So sales minus cost, that will be your contribution. So 10 minus 2. Okay, 10 of the transfer price, 2 of the manufacturing cost. You deduct 8. That's why your 8 is your contribution per unit, per component. That's why you have multiplied by 8 the volume, sales volume here. Multiplied by 8, 8, 8, 8. Now do you understand? Because it is 10 minus 2. 10 is the transfer price, manufacturing cost, MC. 2 is the manufacturing cost. That's how you get C, contribution. I'm writing it here for you. That's how you get 8. And multiply by 1.04. What is this for? Inflation. Inflate. 4% inflation in euro. You have to inflate it. Do you have to inflate it? Did they mention it? Yes. Increase in line with Eurozone annual inflation of 4%. They have told, clearly they have told. If something they clearly tell you to inflate, you have to inflate. If they don't tell, it's not very clear that you have to inflate or not, then you leave it. You don't inflate. But clearly they will always mention what items to inflate, what not to inflate, and what is already inflated. Like in the first case, in your coming to CL company, in the beginning, you didn't inflate. It is already inflated. You just copy pasted it. So, and this is a 25 marks question, so this simplicity is expected. If it was a 50 marks question, you would have to inflate that also, you would have to inflate this also. You have too much of working to do. So this is what I'm trying to show you, the nature of a 50 marks question and a 25 marks question. The working is very less. They will try to make it simple. Sometimes they will directly give you a figure. Okay, so coming to that, okay, they are increasing it here. If you see 1.04, 1.04 to the power 2, but coming to the third year, okay, these are the answer. This will go to the table contribution. This again they are multiplying it. Okay, you have to already see it is not 8 into it's not 8 into 1.02 only. No, you also have to be, it has to be this from the before it's coming, whatever the figures which are coming from before, on that you have to inflate it by 2%. That's why this is here, even this is here in this case. Okay, because here it will not be to the power of 3, same only, because you are not inflating. Fourth year inflation is this one. This is not 1.022, it is 1.02 to the power of 2. Okay, it's a mistake, printing mistake, or maybe they forgot it to show, they were not able to show it maybe to the power 2, but it is 1.02 to the power 2, not 1.022. That's a mistake, please correct it. So this figure will go and put it in the contribution here. Okay, no need to convert, already it is in euro and you are writing the cash flow in euro. Copy pasted, just take and write your contribution here. Okay, so this is done, this is done, this is done. Now what? Tax. Don't forget the tax in that country or this country, tax has to be there. It's a pre-tax. So tax on net contribution. Now what is net contribution? What is net contribution? Okay, it is they are taking the tax, they are rounding up, they're rounding up to one decimal place. Okay, so they are taking the tax on contribution only on contribution. You are not supposed to add the remittable cash flows with the contribution and then tax and then take tax on that. No, you are only taking tax on the contribution. Tax on contribution, that's it. You are not adding with cash flow. So 20% of 20, oh my god, I'm not, again this is not writing. So 20% of 0.9 if you take, okay, you will get 0.18. So that's 0.1 and they have rounded up to one decimal place. That's why it is 0.2. In fact, all the figures are rounded up to one decimal place only to keep it simple. Even you can do this. You have the freedom. Whatever decimal places you want to keep. For example, you might want to keep in 2 decimal places. You can do it. If you want to keep in 1 decimal places, you can do it. Okay. So it is, but don't round up to whole number. Otherwise it will be 0. Okay. And maybe the number might be bigger than your component contribution. Then you will get a negative figure, negative cash flow, which should not be the case. So 0.18 round up to one decimal place, it will be 0.2. Likewise, 20% you have to take on this contribution, this, and this. Then deduct it, then get the cash flow. Okay. Now, once you get the cash flow, you know what you have to do. Discount it. Discount factor is given as 16%. You have to use 16, not 13. and all figures are in same. So just take the cash flow and write it. Okay, discount, and then the present value. Okay, next is the present value. Okay, it should not be like that you do in your calculator only everything and find the net present value. No, you have to write this present values here, 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 here. It has to be shown. This has to be shown. Then only you are writing your net present value, which is negative. If you see here in euro, if you see the currency is there, currency have to be there. Without currency you are not getting marks. This is an international net present value question. So 3.3 million, if it's million, write million, if whatever it is, 1000 or 10,000 or whatever it is. Now this is you are using 16%. Okay, now you are using 13% and seeing. Okay, just the discount factor you used, cash flow will be in euro, same everything. If you see like that, present value you are getting a positive. You are getting a positive net present value. Now why did that? Because the question asked. Look at part A again. Evaluate the suitability of the investment proposal in Canada, including the impact of the country risk premium or the net present value of the project. If you read this first time, you would have not understood. Including means even before including you have to take, and after including also you have to take. That's what it means. So before and after. Before and after. Before and after means what? 13% discount rate also you have to take, 16% discount rate also you have to find the net present value. They ask this question, which is not very clear when you read it like this. Because we always assume including means impact means only with 16%. No. Otherwise, how will you show this impact? This impact, how will you show if you don't know what is before and after? Whenever a question comes impact, show the impact. Okay, please, before, after, before, after. I keep on repeating this. So you have to show, because then only you can comment. Otherwise, based on that, you will say reject based on the 16%. Now, next you have to comment. Did they tell you to comment? No? But you have to comment. Calculation is not enough. How will you evaluate the suitability if you don't comment? So comment. You have to express, you have to write through sentences. Okay, and it's not so big. So let's read the comments, and this should be your comments. Okay, this is how your comment. Just see how they divide a point in paragraph, how they start the sentences, how they end the sentences, the keywords they use in every question. Okay, so the decision whether to accept, this is always the first line in net present value. Okay, decision whether to accept or not. Project critically. Okay, one factor, it depends on what factor, discount rate. Critically depends on, critically, the words, use such adjectives. Substantively, importantly, very significant, critically, very huge, enormous impact, huge impact. It makes it puts a lot of impact on your answer. Trust me, it does. But for that you have to know also that this is the important factor. Yes, discount rate is the most important factor for accepting and rejecting a project, because if it changes the discount rate, your total net present value, just now you saw it changes from negative to positive just by 3%, only 13 and 16. It looks very small, but it had a huge impact in your net present value. That means your decision also will change. So the decision whether to accept or reject the project critically depends on the discount rate. Switching from a negative, write a figure. In your comment, always write a figure when you have done some calculation. Not all the workings, just the main net present value. In negative, what you got, in positive, what you got. And when the discount rate includes a country or risk premium to a positive net present value. Sorry, negative when the discount rate includes a country risk premium to a positive net present value when there is a no premium. Isn't it very simple to write? Do we have to think so much what to write and how to write it? You don't have to write so beautifully. You're not writing English essays here. But this is very simple. What you did only you're writing, what you're thinking. Okay, the calculation what you got, you're just expressing it through words. That's it. Just 2 lines or 3 lines is enough. Now, this adjustments to the WACC requires further investigation because it is possible Covenant could reject projects that increase shareholder wealth. This is the insight you are giving to the report. Not many candidate could think of this line. So this is what I'm trying to tell you. The more answers you keep on doing and read more scripts, it's very important to review your answer. Most of you maybe are just attempting mocks or past paper but not checking your answer, not reviewing yourself with how your standard should be supposed to be. Always keep your standard high. Always expect more from you. Don't expect less. Don't be satisfied with less. What happens is when you in your practice session when you expect more and more, you try to perform better and better. In the exam day, you automatically, naturally, you will perform better at your best. The moment you're happy, you're satisfied with the least, you're like, okay, let's say I passed 50%. Don't stop there. Keep working higher, higher, harder. You should, at least when you're doing mocks, your aim should not be to get 50%. Your aim should be to get 60, 70, 80 if you can. At least 70% or 60%. Because the mocks and all, if you do better, your real exam, you will automatically, naturally, it will come to you. It's a flow. You don't have to work hard. You don't have to put more effort on that. But in your mock session, now is your mock session time going on. Okay, if you give me mocks, I will mark your mocks and give you. If you want to, if you want, you can review on yourself also. So this is your mock session. So this things I need to tell you, because this things no one tells and people go wrong. On the day of the exam, they come to realize that these are the mistakes they did, and if someone would have told them, if this word, I hate this word, if you had, what did you do then the 3 months when you had so much of time to study, and you're coming now and telling, if I had this much of time to do, I would have changed my strategy, I would have done this, I would have done that. The truth is not that. The truth is procrastination. You don't want to do when something is there on time, or before time. When you have lots of time, you feel very relaxed, you're calm. You should not be calm. That is the point. You should not be calm. You should be like thinking that there's less time. I have to do this. I have to hurry. I don't have much time left. The more you train your mind like this, you automatically will wake up and start working. The moment you think, okay, come on, I have 3 months left, I will do it, I will do it, this I will do it attitude will keep on. But your work will never be get done. You understanding what I'm saying? So it's very important that you have to stop this procrastination. You should not say I will do it. You should say I must do it. I have to do it. It's a must, no option. Okay? So please do this. So this point, what I'm talking about, adjustments. Okay, so the adjustments to the WAC needs further investigation. So always try to, when you're writing comment, in your comments or recommendations or advice, whatever you're saying, always write this word investigation. Further investigation is required on this field. Further investigation is required on this thing. These are the words of a financial advisor. You are a financial advisor. The exam you're giving, right? Your role is a financial advisor or a consultant. You are consulting only. What should they do in this project? So consultants, they never say that you have to do this. They always use these words that, okay, I am not very much sure, but I have done this other calculation. Based on the calculation, this is the result, but further investigations are required. So these are the words they use. And these are the words you have to write in your answer. Okay. Why further investigation is required? Because small change can make a big difference. That's why investigation is required. They have told also, because they could have rejected project that could have increased shareholder wealth. The moment you realize, okay, how do you know that you are going on the right track or you are all set for the exam? The moment you are able to think this point beyond something, the moment you are able to think beyond the minimum standard, we all know, okay, net present value, what to write, something which is adding value to it. The moment you are able to find out or identify, write it, that time you understand that you are on the right track, you have done your job well. The moment you're struggling to write answers, even though you know something, but you're not able to explain it in your words, that is the time you need help. The most help you need at that time only. because something is not going right. So don't be happy if you are very good with calculation. That shall not lead you anywhere. Don't underestimate. Calculation and theory goes together hand in hand. You cannot drive a car without a petrol. You need petrol. But you cannot you just, if you don't have a car, what will you do with the petrol? It's useless, right? Like that, calculation is also useless if you don't know how to put it in words. Okay. So coming to the second paragraph, the outcome assumes the contribution and the other cash flows are reliably estimated. Assumptions, I told you. 25 marks question, not list of assumptions. One or two assumptions is enough, but assumption you have to write. They didn't tell anywhere, but you have to write assumptions. One or two is enough. This is 25 marks question. Because clearly they didn't specify to write assumptions. In that case, one or two assumption is fine. But if they tell you specifically to write assumptions, then you have to write at least 4 to 5 assumptions you have to write. But if it is a 50 marks question, then maybe 5, 6, 7 also. Depends how many assumptions is there. One is, I told you always about reliability or accuracy. Okay, so the outcome assumes the contribution and other cash flows are reliably estimated. This could be your one assumption. Other critical inputs include what? Critical inputs include the assumption that land and buildings will increase in value at an annual rate of 30%. Isn't this an assumption that they will increase at a value of how will you know today that value will increase at 30%, that also for 4 years? Something of this statement, whenever it is there, write it under assumption. I'm telling you, these are the ways for you to find assumption. Most of you ask me, how do you know what are the assumptions? How do I find assumptions? These are the way you find assumptions. When someone says that will increase at this rate, growth will be at this rate, they put some price or some money or some number they try to put in some scenario which is going to happen in future, that is your assumption. Okay, isn't it simple? That is very simple. Once you know all these techniques, you will be in love with AFM, trust me. Because finance is one subject which I can do, I don't know, I can do it anytime. You tell me a question, I will be able to solve it anytime. I'm always, because I don't know, something is there, but I love finance. Even tax, same thing for tax also. Both tax and finance, I can do it anytime. I can even teach also anytime, anywhere. You tell me 24/7, I can teach. I will never get bored. With tax and AFM, this subject. This is such a subject, such a beautiful subject. Once you know these techniques, little techniques. And the good thing is you can apply in any paper. Same, it goes in same any paper, even for tax, even for SBR. SBL, yes, a little more, a little bit is different, but then yes, these three papers you can. And that any disposal is tax exempt. They told disposal is tax exempt. It's not always tax exempt. Some disposal is only tax exempt. Through tax, we know that. Now I don't want to list all those taxes. So don't try to bring tax over here, okay? Some of you, when you see these words like tax exemption, tax level depreciation, you try to bring tax also, because thinking that you're not getting points from AFM, if you try to bring some points from tax, you will get points. Don't do this. When it helps, okay, you can, but when it does not, when it's not needed, don't do that. Don't overdo something. Okay, the point have to be relevant and to the point. Coming to point B, part B. Part B was what about the possible strategies how to avoid for controlling the dividend remittances. This is your textbook knowledge, so I think I shall be able to go a little faster on this, and it's small because it's just 4 marks. So there are a number of possible strategies to avoid exchange controls on remittances. Colvin could please refer the company. You might have to write it 5-6 times in an answer, but it's worth it. Write the name of the company, because this is not, don't keep your answer general. I know it's general textbook also, but refer to the company. So Colvin could increase the transfer price paid by cabin and subsidiary for the gearing system component. It is for the gearing system. Everything they're referring to the case study. This would increase. So first line they are giving a scenario, exact line what happened in the scenario. Then they are saying what impact this will have. So this would increase Colvin's profit to the detriment of the subsidiary's profit. Whose profit it will increase? Colvin's profit, but to the detriment of the subsidiary's profit. Subsidiary's profit will suffer, Colvin's profit will, he'll be happy. The parent will be happy, subsidiary is suffering. Why? Who is increasing the transfer price? Colvin could increase the transfer price paid by. Okay, so Colvin could increase the transfer price paid by Kevin. Kevin, the subsidiary is paying. So now, parent company increases the transfer price. So the subsidiary company has to pay more. So who is suffering? Subsidiary, right? His profits will go down. But on the other hand, parent is receiving that increased transfer price. So he's benefiting. His profit will go up. So that's what they are saying. Now this line you can say in any way. Okay. That flexibility is there. You don't have to write exactly copy paste this line only. Alternatively, Colvin doesn't currently leave a management. Okay, so when you're talking about transfer price, okay, dividend remittances, okay, the main topic is dividend control on so the control on dividend remittances. What does this mean? This has what? All this management, transfer price. That's why we mentioned about transfer price, how it increase can have an impact. Next, alternatively, Covalent doesn't currently levy a management charge. They don't levy a management charge or a royalty. So another word is management charge. Okay, these are the ways they can increase their dividend remittances. Royalty, but if this were introduced, it would transfer profit from the subsidiary without the need for a dividend. Okay, so without the need for the dividend, if you increase this, if you increase a royalty, if you say the subsidiary, if a parent company says a subsidiary, you have to give me a royalty, you have to give me some management charges, then even without taking the dividend, even without the need for taking the cash flow as a remittance dividend, okay, you still can get the profit from the subsidiary. The parent company can get the profit from the subsidiary through royalty, through management charge, through increase in transfer price. Okay. So these methods assume the exchange control imposed in Canva are not applied to reputations in general. Okay. These methods assume that exchange controls imposed in Canva are not applied to reputations in general. Assumption is there. We have exchange controls. So they are saying for these reputations, there is no exchange control. An alternative would be for Colvin subsidiary to make a loan to Canvian subsidiary of another Eurozone based parent company, which in return would lend to an equivalent amount in euros to Colvin company. Okay, so they are making a loan to Cavian on euro. Okay, so this will lead to an equivalent amount in euro to Colvin. The same objective would be achieved with a currency swap, although our counterparty risk would be a factor in both cases. Make sure you know all this from your textbook. Coming to part C. Part C is a lengthy one. Part C, they told about discount rate something. I kind of forgot, so let's see. It's for 6 marks. So discuss the validity of QX of adjusting the discount rate. So adjusting the discount rate. Okay. Colvin's investment in Canva does not involve a change in businesses or capital structure, does it? Same line, no? Same line, so businesses will not change. Capital structure, they told it will not change. Okay? Because that's what they told. Read under discount factor. You only need the last para. They told that the board proposes financing the project with a mix of equity and debt in such a way that the existing capital structure remains unchanged. Okay? So also it looks like in a similar line of business. So business risk will not change, capital structure will not change. Okay. The company's WACC would normally be expected to provide a reasonable measure of risk for the new project. Yes, that is true. So the chief executive's justification for a risk premium is based on the increased risk the company is exposed into in Canva developing. Now you are giving all the factor from the case study. They are saying that this could be justified because there's a risk premium. Increased risk is there for this country. due to this factor in that country. What are the factor? Developing. First of all, it's a developing country. Second, which is compared to the company's existing business in Eurozone. It's a developing economy. Second, political risk and all those things. Okay, so this perception of interest risk is based on a country risk index. You have to justify. When you justify, whenever you have some authoritative sources, please put it in your answer. It's a must because you are justifying something. This is like a case going on. When you're fighting for a case in the court, what do? All the justifications. Wherever you have authoritative evidences, you try to bring out. What is the authoritative evidence? The country risk index. They are not just saying this, that they are developed. They are saying this based on some sources. It's an authoritative sources. Country risk index. Okay, they have mentioned it in the case study, but you cannot tell it if they haven't mentioned it. You have to use it if it's mentioned in the case study. Otherwise, you should say that much information is not there. You further investigation is required. So coming to this, okay, here she made this decision after consulting a country risk index. It's an authoritative source. If they say it's a developing, yes, it is. So this perception of increased risk is based on what? Country risk index, which compares the standard deviation of market indices around the world from the case study only. Chief executive has incorporated other factors. What are the other factors? Political risk is there, yes, because if opposition party comes, then there's this other risk, and foreign exchange risk in determining this premium. Okay, so foreign exchange risk, we'll see whether it is incorporated or not. Yes, they have told. Additional factors taken into consideration include foreign exchange risk. Knowing what information from where, in which part of the case study to take in your answer is also key. Like for this, if I keep on searching my other paragraphs above, it will waste my time simply because nothing is there. Everything is from this last paragraph, discount rate. Okay. So yeah, so political risk is there, foreign exchange risk also they have taken. These two factors also they have taken into account. Now coming to the next paragraph. However, standard deviation is not the appropriate measure of risk for Colvin's investment, since any proportion of total risk that is uncorrelated across different markets may be diversified away at no cost to investors. So they are saying standard deviation is not appropriate. Reason is given. Read it. It's not appropriate measure of risk because they told that country risk index compares the standard deviation. So they are saying now it's not appropriate. For example, please give examples. If you are lack of point, not able to give point, give examples. Adverse political events in Canada may be partially offset by more favorable events in other parts of the world. Yes, maybe in one country they are having political unrest, but in other country they might be benefiting, so that can be offset. No rational investor would pay a premium for risk that can be avoided. Exactly. Why would you pay a premium for a risk that can be avoided? Isn't it better to avoid the risk than to go for the paying premium? In this sense, although Covenant's investment in Canada is exposed to foreign exchange risk, this too can be mitigated by an appropriate hedging policy. Why are they saying this? Because see, they are saying that okay, in this country they have political adverse, but if they have favorable even in other country, then that political risk can be offset. So that is gone. Now they are left with only foreign exchange risk. Even this can be offset. This can be mitigated by hedging policy. So now do you see how they are coming to answer? They are dealing one at a time. They talked about yes, there's political risk, but that can be avoided. Then we are left with foreign exchanges. They are saying this also can be mitigated using hedging policy. Okay. And they're also saying developing country based on what? Country risk index. But they're measuring what? Standard deviation. Even standard deviation is not an appropriate measure of risk. So one by one, there are three risks they're told. All the three risks they are saying it is not valid. Furthermore, Covalent's institutional shareholders are likely to be well diversified. Institutional shareholders, you have to talk about institutional shareholders. Why? From where? First line. When you see this paragraph, okay, this is another thing I want to tell you here only. When you see that you have maximized this paragraph whole, you have used all the information. Now you don't have any more information to take from here. Go up and see. Go somewhere and see whether you ever. This you will not be able to take because this is just your net present value. So first paragraph, your information will be in your first paragraph only. Most of the information, theory part will always be in your introduction part, beginning. This is the key, which I have identified. I have got it on my own. No one told me. No one ever told me these things. That is, the remaining shares are held by a number of institutional investors. Institutional investors. Institutional investors are not small, they are very big shareholders. So they are talking about it. Okay. So the institutional shareholders are likely to be well diversified across global markets. Yes, they have shares in so many other countries, so they are already well diversified. And asset classes. So the potential for further risk reduction by Covalent from diversifying operations globally is therefore limited. It is limited. Okay. There are not much chances of Covalent to reduce their risk further by diversifying, by going more abroad. It is limited. When the shareholders can achieve this more efficiently on their own. Coming to the last paragraph. Okay, the last one, if you see, it's part 3, so this is already done. I've done question 3. The only component of total risk, you have to talk about total risk. You're talking about discount rate, so discount measures total risk. No, it does not divide systematic and unsystematic like that. So the only component of total risk that could justify a premium, now you're justifying, so they are saying out of total risk, unsystematic and systematic, the one which could justify a premium to Covalent's cost of capital is what? Market risk or undiversifiable risk. Mention it when you're talking about risk and discount capital. So the cost of capital or WACC, you have to talk about two risks. One is unsystematic, one is systematic risk or market risk. This assumes returns across countries are significantly positively correlated. For example, there's a strong possibility that a recession in Eurozone may lead to a downturn in Canada too rather than offset it. Correct? One country suffers, like in this global COVID. You can see COVID. One country affects the other country also automatically affects. China was the first one to get affected because of that other countries, with the Middle East countries and all those countries who was dependent on China for inputs are suffering too. That is called a positive correlated. There's a positively correlated. Transmitted through trade links and closer integration between markets. Yes, this tendency for market across the world to move together means reduced risk reduction benefits from diversification. Yes, reduced risk reduction benefits from diversification means you are not going to get much benefit from diversification if this link is there, if it is positively correlated. Because one market suffers, other market also will suffer. How will you reduce your risk reduction? It should be the other way around. If one market suffers, okay, I can get gain from the other market. Then it's okay. If it is negatively correlated. But if it is positively correlated, both goes in the same direction. You cannot benefit from there. Positive correlation means both are going in the same direction. One increase, the other one increase. One falls, the other one falls. So hence a higher cost of capital. Yes. Then if you go and diversify, higher cost of capital only. So the key issue therefore is whether the risk of new investment is diversifiable or not. What is the key issue in this case? You cannot justify in this case. Why? You don't know this project is diversifiable or undiversifiable. That's why you are saying this. Whenever there's some key issue, you're not able to understand or justify what this project is, then write this. The key issue is this. You don't know whether the new investment is diversifiable or not. If you have to keep a possibility of answers, okay, in this case. So if returns across markets are significantly positively correlated and the risks are undiversifiable, the new project in Canada may therefore command a risk premium. Yes, if it is positively correlated, go for risk premium. Accept it. But although no justification is provided for the chief executive's premium of 3%, because 16 minus 13, 3%, which would require further investigation and analysis. So no justification you are giving. You don't know this investment, whether it is diversified or not. So you cannot justify also. So if you cannot justify, what do you have to do? As I always say, further investigation and analysis. Halas. That's it. Isn't it very simple? Right? Let me see whether the marking scheme is there or not. Yes, I have the marking scheme with me as well. I was looking for this. So we are done with this question. Now let's see how the markings are get. Exchange rate you have to convert and write it, not in your calculator. You have to show the working. First year, because you are using a purchasing power parity, you have to show first year, second year, third year, fourth year, what is exchange rate. So 2 marks. Tax, another 2 marks. For tax, we have 2 marks here because tax losses are carried forward. Again, it is added back. Working capital also 2 marks. We have a working. Land and building residual value, yes. Because we have a residual value. Remittal cash flow in euros, 1 mark. Contribution from component also. Tax on contribution. Net present value, comment. Comment is 2 to 3 if you see. Up to 2 marks, transfer price, royalty. Yes, 4 marks are there, no? So you can just say transfer royalty and explain, or you can give 4 points, explain briefly. 6 marks. Up to 2 marks per point. So argument for WACC. Total risk versus market risk, correlation across countries. These are the things you have to talk about when you're talking about WACC. So now you know in future when you get this type of question, what are the things you have to include. This were not there in your textbook maybe in detail, so that's why I have included this in this video. So that's it for this video, and don't forget to subscribe to my channel because I'll be soon coming with question 1 as well. And also I am towards the end of the revision kit of AFM. I think I'm just left with 2 or 3 questions which I'll be doing, and then you'll be done. Best of luck for your AFM and do practice all these techniques. Do take care. God bless.